Now, don't forget, as we look at different entries, exits, instruments, all of this is from an educational perspective. The whole idea of this week ahead webinar is that you're sort of looking over my shoulder and see how I'm preparing for the week ahead. It's an educational service, not a signal trading service. Those of you who are here regularly understand that it's an educational service. Looking at the Aussie and the CAD in particular this week, as well as looking at oil after the OPEC meeting. We'll be looking at the dollar and what's going on there. So without further ado, let's jump over to the charts and let's look at the oil markets for a start. Now, oil markets jumped higher on the production cut, surprise production cut at the OPEC Plus meeting from Saudi. And you can see here, price spiked up, hit that 75 and has sold off, found buyers on the dips. Now, this is called technically a rising window. So when you see this rising window like this, what you can see is typically this bottom edge of the rising window is the most important support. So this now forms a support area, okay? So what you want to look for is this area holding as a support in the US session. Now, I've been long oil, and I was long oil heading into the OPEC meeting from last week. So look for potential support in this area here, which is now currently holding. If that area holds, does open the way to break through that overhead resistance area we've got here at 75 and opens up an opportunity to test sort of 75.50, and then if that holds, then we can look for a potential deeper run up. And if we just do the up to sort of just that sort of 76 region, which would be a test of that potential trend line. So 77 would be a decent run if this breaks. So watch this carefully. Now, remember the last time OPEC Plus did a surprise production cut, we saw oil gap higher up towards 80, then it took off and then it sold off very heavily, right? So remember, the reason Saudi are doing a production cut is partly because of the slowing global demand that analysts have been seeing, and mainly China's recovery has not been as quick as many investors have been hoping. So just to see, if you look here at, I think it's this one here, I wrote an article on I wrote an article here on does oil have a supply or demand problem? And recently, what's been happening is because countries like Russia have been able to get their oil to market, and many analysts were thinking they wouldn't be able to get their oil to market. They've been seeing that as, you know, oil prices have remained pressured. So those pressure in oil prices, even when Saudi cut last time, it then sold off. Now at the moment, we can see prices have, you know, moved up the overhead. Sellers have taken it lower, and we're going to see how the US deals with it, okay, as we go into the US session. But just to be aware that this kind of support level on the intraday chart is your current kind of support, that window, okay? So that's a support level, and look again very carefully around these highs, this 74, 75 region. Just wanted to cover that. Now, let's get into what we've got coming up for this week. Now, a couple of things to note. So for today, we've got some ISM services print coming in later. Now, what to look for here, the best tradable opportunity here for me would be in the gold market if we see a huge miss in the data. Now, remember the Friday data, we saw some stunning jobs data from the US. Headline 339,000, well above the maximum expected 293. So that's 339,000 jobs added to the US. And on top of that, excuse me, on top of that, participation rate higher and average weekly hours. And the government payrolls higher and average hourly earnings as expected. Now, the negative, of course, was unemployment was very high, 3.7%. And that was up towards the high of the estimate, but that was an outlier. The person who had that, there was only one investment bank with a 4% outlier. That was a very surprising. So it's a mixed jobs report, but the market focused on the headline, and that sent yields higher on Friday. So what that means is for today, what we need to look at very carefully is that jobs component of the ISM data point. See, the employment component. If that falls significantly lower, and we see that as a big miss, that will be important. And look at the new orders as well. Now, throughout the last few weeks, manufacturing has been falling when services has been picking up. So you can see here how the services, look at those prints, 59, 56, well above expansionary territory of 50. Manufacturing have been like, 40, 45, let me just show you this. So look at the services PMI. You see how that's been going, gaining in the US. But look at the manufacturing PMI. See, it's been generally falling and above that contract, into contractionary territory. So there's been a mismatch between the two. So if services PMI all of a sudden shows a big drop today, then I'd expect yields to fall lower. I'd expect the dollar to fall lower, and I expect gold to lift higher. So say the ISM services, say it misses across the board, and that reading comes in below 54, then I'm expecting gold to move higher. If it comes in high, I'm not expecting any trade. I'm just leaving it. For me, the best opportunity will come from a miss. If we see the services falling in line with manufacturing, then that should mean the Federal Reserve need to do less. So there's more likely that the Federal Reserve will pause rates. That should weaken yields, right? Let me just show you here. So that should weaken yields. Just come across that. All right, so expect yields to fall, and I'd also expect the dollar to fall. And dollar's very strong at the moment. It's one of the strongest currencies at the moment. If I look at that correctly, see the dollar is one of the strongest currencies of the day. Yeah, so dollar's the strongest on the day. So it would be interesting in buying gold at the moment, right? We want to see that dollar weakening, and a big manufacturing miss will be the thing that would most likely weaken it. So that's first opportunity. Then we go into the RBA interest rate decision. Now I'll be looking here at the Aussie New Zealand dollar pair. Now, if you look at this, this is my this is HYCM's blog. I write virtually all the material for this blog. And if you look at the last interest rate meeting, right? In fact, I'll give you the link to this blog, and I'll give you the link to this page, right? Now, if you look at the last RBA interest rates, they surprised with a hike, okay? And that boosted the Aussie, and particularly boosted the Aussie New Zealand dollar pair. So what we need to look for now is, what are the RBA going to do? Now, this is what they're expected to do, right? Short-term interest rate markets are saying this. Short-term interest rate markets are saying, we're expecting the Reserve Bank of Australia to hold rates, 60% chance, right? So if they hike by another 25 basis points, then you'd expect the Aussie to gain against the New Zealand dollar. So the currency pair I'd be looking at will be the Aussie New Zealand dollar pair. I would expect that to surge higher, right? Now let's just collapse that pane, right? And you can see here, that was the last time, when the RBA met last time, right? The RBNZ rather. The RBNZ was much more dovish, right? And we've seen a big spike in the bond yields between the Australian and New Zealand 10-year bond yield. Now, we could see this continue to move higher if the RBA are more aggressive. Now, if you look at inflation for Australia, you'll see something that is noteworthy, right? The headline is 7%, so it has fallen 1 month, right? But look at the core reading. The core is still nearly 3 times above the RBA's target, right? That is very difficult. So there is there is a significant chance that the RBA hike again by 25 basis points, and short-term interest rate markets are only giving it a 40% chance. So in other words, there's 60% of pricing that would need to be going into this aspect of a Aussie New Zealand dollar long. So if they do hike by 25 basis points, then expect the Aussie New Zealand dollar to gain significantly up to that 1.09 for ST1, and then 1.0950, and then probably back up towards that 1.10500. So watch this very carefully, okay? And we can see this is starting to break out and wanting to break above these highs. So the catalyst would be a hike with the RBA saying we have to do more because of this sticky core inflation. Definitely big one to watch. Then on Wednesday, right, we've got some GDP data, and remember, you can look at that in light of the Aussie New Zealand dollar pair. So if that's going up higher and growing, then that should give Aussie dollar more strength. But the main event to look at on the Wednesday is the Bank of Canada interest rate decision. Now, if you look at the interest rate market's expectations for the Bank of Canada, what you'll see is they are expected to keep on hold. 31% expecting to keep on hold, but there's a 69% chance now that they'll hike by 25 basis points. And short-term interest rate markets are seeing a terminal peak of about 4.89% by the end of this year. So the expectations are that the Bank of Canada is going to hike. Now, if you look at the short-term, you look at the COT report, you'll see that there's a lot of traders are short the CAD. Now, that makes sense with oil being quite weak recently. CAD is being weak recently, so it means the best surprise will be an upside surprise. So say the interest rates do rise by 25 basis points, and the Bank of Canada expect more interest rate hikes to come, and say we've got to do more to combat inflation. And if we just look at Canada's inflation data, we can see that their headline, 4.4% for the headline, that's pretty decent. And the core inflation is 4.1, so that's better than it is in a lot of other places around the world. So that would indicate that they could potentially hold interest rates, and you can see that there's a sort of 31% chance that they'll hold interest rates. So the best opportunity would come from a hold, actually, now I think about it, because there's 69% pricing for a 25 hike. So if it's a hold and they indicate that they're not necessarily hiking interest rates any further, then you expect that to weaken the CAD. So if the dollar is still strong on Wednesday, then I would look at US dollar CAD upside. Otherwise, pair the CAD with a weak currency if they hold, because with a strong currency if they hold, because I expect the CAD to weaken if they keep interest rates as is. Then on Thursday, not a lot, bit of a quiet session really, followed by Friday, when got some interesting data, Canadian employment data and inflation. Now, employment is the kind of step before inflation in many ways. So what that means is that if the Bank of Canada sees a lot of people in work, they translate that as being inflationary. And the reason they translate that as being inflationary is due to something called the Phillips curve. Now, let me just show you the Phillips curve. Right. Now, the way it works is if there is a very low unemployment rate, right? So in other words, if people are in work and the unemployment rate is very low, then that results in a very, so if unemployment rate is high, so if a lot of people are out of work, they see that as deflationary. Why? Because people aren't in work, they aren't able to demand higher wages, they have to accept lower wages from companies, and as a result, that puts less inflation into the economy. So high unemployment is deflationary. The alternative is if we have a low unemployment rate, in other words, lots of people in work, Central bankers translate that as being good for inflation and inflationary. Why? Because it means that most people are in work, and therefore companies have to offer higher wages to attract the workers that they need. And so in order to encourage people to come to them, they have to have higher wages, and those higher wages result in high inflation. So this is the key relationship to understand. Now, how does that work for Friday? Well, it works like this. The expectations are that the headline figure is expected to see jobs fall to 20.8 thousand from 41.4, right? Now, if we look at the employment data, let's have a look. For Canada, let me just go and have a quick look at the unemployment. See, unemployment's at 5. Employment change 41.4, so it's been sort of fairly steady around that 41.4 thousand mark. Full-time employment steadily falling, expected, minus 6.2 last time, and part-time employment is rising. So looking at this, if we see unemployment, if it rises according to Phillips curve, that means higher unemployment is deflationary. So in other words, what we want to see is if this comes in as a surprise miss, so an on aggregate miss, if this comes in 4.9% or lower, if the employment change comes in 30,000 or higher, if the full-time comes in, the majority is full-time, less of that is part-time, then that would be seen as inflationary, which would support the CAD higher. So you could look for CAD strength. Now, if you see the opposite, if you see unemployment rate high coming in at 5.2%, if the employment change comes in low, below 10,000 jobs added, and the majority of those jobs are part-time rather than full-time, then you would expect the Canadian dollar to fall. So that's what I'd look at. But remember, we've also got to factor that in light of the Bank of Canada interest rate decision. So as if they're very hawkish on Wednesday, but then the employment data contradicts that hawkishness, you could see some of that CAD strength reverse quickly. And vice versa, if they're very dovish on Wednesday and say, that's probably, we don't need to do any more interest rate hikes, and the CAD weakens, but then employment is very strong, it might indicate that the Bank of Canada's got it wrong. And so you could expect to see the Canadian dollar reverse some of those early losses if the jobs data was really good. So bear that in mind when it comes to what happens. Now, a couple of things to note from the COP report. Just looking at pricing, so euro longs are very stretched, pound longs are very stretched. So look for bad news to weaken the euro or the pound. And again, the CAD and the yen are very stretched to the downside. So with the yen shorts being so stretched, the thing to look for is if the Bank of Japan indicate that they might be exiting their ultra loose monetary policy. In that case, you'd expect the yen to strengthen. So you'd look for something like maybe a pound yen short would make sense if we saw the Bank of Japan indicate they're going to exit their ultra loose monetary policy. Aside from that, just to be aware that markets are very tentative at the moment. There's a lot of risks going around at the moment. There's talk of this liquidity issue that's happening because of the US Treasury market. There's worries about global growth. There's concerns about artificial intelligence. There's worries that perhaps earnings are going to start, corporate earnings in the US are going to start to show a sharp fall. So Morgan Stanley expecting that to drop lower, but Goldman Sachs saying no, we expect to see a mild bull market. So there's a lot of various views out there at the moment. So remember, it's very tricky trading. Don't forget, there's been a lot of artificial intelligence hype at the moment. We've seen a lot of interest in some of those big AI stocks. So remember, some of the stocks that are really exposed to AI are stocks like Nvidia, stocks like Netflix, Amazon. We've also seen stocks like, I think, C3 is another stock that's really exposed to artificial intelligence, MicroStrategy, Microsoft, obviously, they own sort of half of OpenAI, and you've also got stocks like Apple, which also have some exposure to AI, and Meta platforms have some exposure to AI, so watch out for that. On Wednesday, I will be back, and what I'll be doing is showing us exactly how to get ready for the Bank of Canada interest rate meeting. So don't worry about if you're not sure about what the outlook is for the Bank of Canada. I will be outlining that outlook on Wednesday at 12:30 UK time. So do come back and I'll show us how I'm getting ready exactly for that, what instrument I'm looking to trade on the day, and exactly what parameters I'm looking for. Okay, folks, it's been an absolute pleasure. Don't forget, keep up to date with my latest analysis on the blog for HYCM. Although it's not officially my blog, you'll see that I do write a lot of the information there for the blog. Just show you here. You'll see there, so do check that out. Okay, folks, take care, everyone. I've also got a little message there about how to get the most of it. So do make sure you check that out. And I hope you all have a very good week. And of course, I look forward to be back on Wednesday. Take care, everyone, now. Thank you, and have a good day. Thank you, Farhad. Thank you very much for letting me know my screen and sound is fine. Much appreciated. And thank you very much, Johan. Good to have you here. Alexandro, again, excellent. Aloitza, Gabriel, good to see some familiar names. Saeed. Take care, folks, and have a very good session. Don't forget that ISM print at 3 o'clock UK time. Thanks, everyone, now, and goodbye.